how would you say the rise of blockchain is shaping fund management and investment into trade finance? Are there any other aspects that it's increasing there?
Yeah, one interesting aspect we are seeing is that blockchains are being now used to operationalize all the day-to-day aspects of fund management.
Welcome to Trade Finance Talks, your go-to trade, treasury and payments podcast. Brought to you by Trade Finance Global.
Hello and welcome to the latest edition of Trade Finance Talks. My name is Charles Osborne. I'm a director here at Trade Finance Global. So I'm very pleased to be joined by Saurabh Goyal, the founder and CEO of Flow Systems. I'm very pleased to introduce the topic of the podcast, how alternative lenders are changing trade finance. So thank you. Welcome, Saurabh.
Thank you, Charles. Thank you for having me.
So, Saurabh, I think you'll agree alternative finance is certainly on the rise. We're certainly starting to see that there is a need for additional liquidity alongside banking finance in the trade finance space. Perhaps we can maybe start by getting a quick introduction to yourself and Flow Systems.
Yeah, as you said, I'm the founder and CEO of Flow Systems. Flow Systems was started in 2016. Before that, I was working as head of CTRM systems for Olam International, which is like a large agri-commodity trading fund and supply chain management business. So it is as part of that experience that I learned mostly about commodity trading workflows and also commodity trade financing. Prior to Olam, I was working again in the trading industry, but trading of financial instruments rather than physical commodities. So yeah, my career has been spanning around 22, 23 years now, all about trading. First half of my career was trading of financial instruments, which is completely automated STP process. And the second half of my career, including in Flow Systems, is mostly about trading of physical goods and all the supply chain and financing activities which are necessary to enable that trading. So yes, very happy to discuss my experience and what Flow Systems is doing and what we see in the industry today with you, Charles, today.
Thank you very much for the introduction. So why do you think there has been such an interest in the trade finance industry by non-bank lenders in recent years? Have they identified this market as perhaps an opportunity with maybe certain banks perhaps retrenching from the space, obviously the fallout, the flight to quality that we've certainly seen? And how is this changing the global trade finance industry as a whole?
Yeah, absolutely. I think the first driver of funds coming to this market is opportunity. I remember when we started Flow Systems in 2016, at that time, ADB, Asian Development Bank, who does the main survey in this market, they said that the trade finance gap for SMEs is around 1.1 trillion. And the latest update from ADB says that this has now grown to 1.7 trillion. So yes, the trade financing gap for SMEs is increasing. And it is increasing because of factors we all know, which is basically banks are not able to service that market because of high cost of compliance, regulations such as Basel, which requires heavy collateralization of trade finance in terms of assets kept with the bank. And therefore, alternative lenders, including funds, are seeing an opportunity where they can fill this gap, at the same time offer a source of earning to their investors. So yes, opportunity is certainly there, because of which funds are coming in. Non-bank lenders also see this as an attractive place where they can earn correlated yields versus traditional fixed income instruments. So it's a play of like diversification of their assets also. Technology is playing a role where, again, the incoming alternative lenders feel that they have an edge over banks and other traditional avenues of financing. And of course, they can offer speed, flexibility, and customized structure. So yeah, so these are some of the factors which I believe is causing funds to come into this market, or alternative lenders to eye this market.
I think that's an interesting point. Obviously, we did see a number of banks retrench, and I think that's kind of exacerbated the trade finance gap. Those that are committed to the space, I think, are still very hamstrung by regulation. We're seeing that regulation increase as we start to move towards Basel IV. So it'll be interesting to see how that possibly develops further. From a borrower's perspective, what would you say are some of the key differences between working with a bank and with an alternative lender? And obviously pricing is going to be a major one, but are there any other kind of aspects?
Yeah, all borrowers and particularly SMEs, they want three things. They want easier, faster, and cheaper financing. I would say that alternative lenders certainly score on the first two aspects. Their processes are easier and they can close the deal faster than the banks. They're certainly not cheaper than the banks, at least for SMEs. But that is not really a constraint, because most of the SMEs price that higher cost of funding into their trade execution. So it is already kind of taken care of. But yeah, I mean, most of the benefits are on the speed and the flexibility which alternative lenders offer, because many banks will simply reject you because you are based out of a certain geography, or you are of a certain size, or you deal in certain commodities, which is not the case with alternative lenders. Their risk appetite is much higher than that of the banks. They can tailor different kinds of deal structures depending on your requirement. The documentation and the onboarding process is smoother and faster, and they follow a relationship model, which is basically the trade financer considers the trader as his friend and a partner in many cases. What we have seen through our experience is that many a times the alternative lender is also playing a value added role. We have seen funds which would offer other services such as hedging of your exposures on the behalf of the trader, because the trader may not have the expertise or the means to hedge himself. They may also introduce the trader to other partners through their network. So yeah, that relationship building and the partnership model is also quite attractive to SMEs when working with alternative lenders.
And how would you say fund administration has developed in the trade finance industry in the past few years? Perhaps maybe since, 2020, and obviously we saw some fraud cases happening then. How would you say it's kind of developed since then?
So the fund space is in a bit of a flux. I would say flux because when we started in 2016, the top funds at that time do not exist anymore. We see many new funds coming to the market. So yes, in general, the trend is upward in terms of the number of funds operating in this space and the total assets under management which they manage. I mean, maybe it is the nature of the business, or it is the still evolving issues around risk management, that we see many funds going out of the business also quite regularly. That is a bit of a concern. In terms of how they are evolving, we see that many of these funds are now moving from manual spreadsheets to institutional grade digital fund administration platforms. Earlier, they were more concerned on the borrower side, that how do they manage the risk on the borrower, but now they're equally concerned about investor reporting, regulations, things like real-time reporting for NAV, exposures, underlying assets, performance. So reporting to their investors is becoming more and more important now. They use embedded risk analytics like concentration limits, counterparty exposures. ESG was quite important until a couple of years back. If they are operating in a fund structure in a particular geography, then they have to follow the laws of the land, and AML, audit trails, transparency requirements are also quite important for the fund to manage themselves. So yes, we see a lot of funds asking for proper fund management systems rather than just collateral management and trade monitoring systems as we used to see when we started.
And just staying on the topic of risk management that you mentioned, because there's often a perception that the trade finance market is risky and more volatile than other areas of finance, which a lot of these institutional investors are typically more involved in. And we're especially seeing this, I'm not going to mention any names, but obviously we've seen some quite high profile collapses in the fund space. We've seen some fraud cases as well. So none of this is a particularly great look in terms of bringing new liquidity into the market. How can resilient and committed fund managers reassure clients that their investments are safe?
It's a bit ironical because if you look at trade finance as an asset class in the broader space of private credit, let's say, then you will see that trade finance as a subset has very low default rates. In fact, trade finance is supposed to be one of the most safest credit option, and their default rates are in the range of like 0.05 to 0.1%, compared to, say, balance sheet based loans given by banks to corporates, where the default rates can be anywhere between 2 to 3%. So trade finance as an asset class has default rates which are like 10 to 50 times lower than that of other forms of credit. But ironically, when the funds come into this business, they do not follow the same risk management practices. So basically, what the funds are doing is that rather than finding safe businesses and providing credit to them, they are just funneling in all the rejects from the banks. I mean, the banks have rejected them not just because the bank cannot service them, but banks have rejected them also because of low credit ratings. If your pool of incoming prospects as a fund are those rejects from the bank, and then if you're not having the same infrastructure, controls, and verification that the bank have, then it is quite natural that your default rates would be much higher. So ironically, that is what is happening. I personally believe that it is, that's why I said that the trade fund industry is in a bit of a flux. And all these cases that we see are cases from which we will learn. And the next wave of funds which will come to the market or are already in the market now would have much better internal controls, governance, and risk management practices than what we have seen so far.
Hey, enjoying the episode? Tap follow for more. Done? Let's get back to it.
No, interesting. And I do agree. How do alternative lenders work to expand access to finance and perhaps expand it to sort of the SME mid-cap range, but also perhaps bring in new liquidity that we hadn't seen before? I mean, I'm seeing huge rise in things like crypto financing, digital asset finance, and we've done a few kind of podcasts and interviews on that. So what's your viewpoint on how alternative lenders can bring this all together?
Yeah, alternative lenders, as I said, their risk appetite is higher. They can move much faster. They can adopt technology much earlier than others. A case study would be ourselves. We were one of the first to launch blockchain-based trade finance market as early as 2017. That market didn't survive because of many reasons, largely because blockchains at that time were slow, cumbersome, and expensive, mostly because the use case was not there. The use case of why trade financing should be done on blockchain was really not there. Now into 2025, we see that the use case is finally emerging. And the use case is emerging because of stable coins. So now because of stable coins, we believe that the flow of not just information, but also the flow of value, which is the fund transfer from investors to trade financer, from trade financer to trader, and in many cases from the trader to the suppliers and back from the customer to the trader, can also be done through stable coins. So now, because not just the flow of information and the trade information and the trade finance terms and conditions can be automated on blockchain, but all the underlying flow of value in terms of money flowing from one participant to other can also be managed on blockchain, and which creates a very strong case. Also, the initial teething issues with blockchain, which is it was slow, expensive, and cumbersome, have been resolved now, largely because of so-called layer 2 blockchain, which is running on top of layer 1 and has been designed specifically for the purpose of making the transactions faster, cheaper, and there's a lot of infrastructure and tooling available for developers to do interesting stuff. So because of these changes, we now see movement of money from crypto native investors into real world assets. Most of that money has so far gone into the larger markets, which is treasuries, but some of that money has also come into private credit. We are starting to see some of that private credit money flowing into trade finance. Even heavyweights such as Tether and Coinbase are actively looking and even deploying funds in trade finance currently. So yes, this is an area to certainly watch out for, and interesting stuff would be happening in the coming days.
Definitely, yeah. We did a webinar on this that caught a lot of interest, one of our Spotlight on webinars. So it is something that's increased, something I didn't really know too much about until the beginning of this year. So it's definitely creeping more into the CTF market. And again, it's one of these where, we can potentially see this provide additional liquidity for perhaps players that are struggling at the moment. What I've heard so far is they're starting with top level traders and sort of working their way down. So it's going to be a longer process. As you said, with layer 2 blockchain, it was something that's certainly been on the rise in the last few years. How would you say the rise of blockchain is shaping fund management and investment into trade finance? Are there any other aspects that it's increasing there?
Yeah, one interesting aspect we are seeing is that blockchains are being now used to operationalize all the day-to-day aspects of fund management. Fund management, as you know, is largely the activity of taking money from investors and deploying that money into different asset classes, managing those asset classes and providing a return back to the investors. In the past, I have heard that opening a fund is not really feasible until you have assets under management of at least, say, 20 million US dollars, because below that amount, the fixed cost of opening a fund management company and all the associated infrastructure around it is quite expensive and not feasible. But now with the DeFi, there are a lot of protocols available, a lot of tooling available for crypto assets to be incorporated into a fund structure very cheaply. We have seen cases where funds with, say, even less than 5 million US dollars have been running successfully operationally on blockchain in terms of all the day-to-day activities that you have to do to run it successfully. So we believe that process will continue, not just for digital assets, but also for real world assets. And there is a good possibility that even traditional funds will start running their middle office, back offices, infrastructure on blockchain because it is now so easy, convenient. And it makes sense because, as I said, blockchain does not just, with the help of smart contracts, automate all the interactions between investors, asset managers, the actual assets which are being invested into, etc. So it can automate all that operational work. But more than that, it also automates the flow of cash flow because assets is all about future cash flows. And how does that future cash flow from the assets back to the asset manager and then to the investor? So the flow of value is also automated through these smart contracts. So it makes the overheads of running a fund on blockchain quite small and has inbuilt risk management and integrity constraints built into it. So we believe that more and more funds will now, not just for digital assets, but for their entire fund management activity, will start looking at blockchain as a technology for operationalizing their middle office, back office, and maybe even front office activities.
Perhaps one thing that we can end on, it's something that I've been quite very interested and have asked on many panels and podcasts and webinars that I've done over the last year, is how we can make SME and mid-caps more attractive for financing. So I think that's where we are at the moment when we're talking about the trade finance gap, is how can they be more attractive? We've already talked on here. The cost of capital is very high. There is this perceived risk, even though, as you pointed out, it's perhaps not as extreme as people think. But how can digitalization perhaps make this demographic, make SME and mid-caps more attractive for financing? How would you say that could be done?
Yeah, so one of the reasons why alternative lenders think that they can manage the risks better for an SME trader is that they understand the trade. So they understand the trade and the risk associated with it. But in order for them to exercise that risk management, they need visibility into the trades as they are happening. So that visibility can be provided by SMEs now at a relatively modest cost with the help of all the digitalization tools available in the market to the trade financiers. And that visibility is helpful in two main instances. One is onboarding of the customer or pre-trade verification. So a trade financier, if they have good visibility into all the past trades of a trader, and they can see their operational performance and financial performance on those trades, then it helps them in understanding the risk associated with the traders and pricing the financing correctly and onboarding them faster. And once they have onboarded, then the biggest concern for a trade financer is that the money which they have given to the trader is being deployed correctly and in a timely fashion and as per the conditions stipulated in the trade finance agreement, for which they would need all the activities which are happening for that particular trade in a streamlined and effective manner communicated to them. Now that communication, if it is happening over emails, over paper documents, will be eventually ineffective. It can be managed when a trade financer has like 3 or 4 or 5 relationships in terms of the trading counterparties. But if they have like 20 or more traders they are financing, then there's no way they can manage this in a manual fashion. So we believe that traders who are using ERP systems, which is systems where every aspect of their trade is being recorded, and these ERPs are modern ERPs, so they have APIs which can connect to the trade financing systems and provide all the information of the trade. For example, whether the goods have been bought, goods have been stored in a upcountry location, warehouse receipts have been issued, goods have been put in a container, goods have been shipped, goods have been dispatched, received, destination location, etc., etc. So all that information, if it is communicated to the trade financiers in real time, it will improve both their access to finance as well as the pricing to that finance.
Very interesting. I think that's a great way to end this segment. So Saurabh, thank you very much for highlighting that and also giving us a glimpse of how Flow Systems effectively works within the industry as well. It just remains for me to say thank you to Saurabh for joining today and thank you for everyone for listening.
Thank you. It was a pleasure speaking with you.